Good afternoon and welcome back to the latest edition of the InvestTalk Market Analysis for the week ending January 19th, 2024. And this week I'm going to title the video, Option X takes markets to all-time highs, but should you be worried? And I'm starting off with this. Now, I think this is a very interesting article, especially the headline. You typically get these headlines, frankly, near a peak. But let's dig into this writer's argument. This is coming from Bloomberg, right? Don't worry about valuations, okay? And what he says, yeah, you had 38% rally from the October lows. And if you go back to those videos that I did back in late summer, I was saying, the pullback was seasonally. It was not anything to worry about because it was orderly. There was no credit problems, etc. And that was a buy. That was a pullback that you wanted to buy, not get panicked about. Unfortunately, some people did get panicked and sentiment got fairly negative. Not as negative as the fall of 2022, but still fairly negative. And obviously, you've seen a pretty strong rally. Now, this is, he talks about how the catalyst here is a pivot from the Fed and a decline in government bond yields. And that's certainly true. And I'll just pull up this real quick. Here's the 10-year, right? This is the weekly. Let me zoom into the daily. And that's the peak, right? Rates pulled back, and that was a catalyst for valuations to run up again. But as he said, the tailwinds have faded, and that's certainly true. But the Mag 7 stocks, they're a much larger percentage of the index. Right now, 29% of the S&P are just these 7 names versus 17% in 2019 and 14% in 2017. And those Mag 7 stocks have a P ratio on average of 28, which, you're going to pay a higher multiple for a lot of those names because they have better growth, earnings growth. They have economic moats that protect their businesses. So I think it's okay to pay a premium, but is 28 reasonable? And he talks about the rest of the S&P is much lower. I think it's down here. It was somewhere around, let me find it. I remember reading it on here. Yeah, I remember it was much lower. If you take that out, it's about 16. Okay. And we're in the midst of earnings season. And so he talks about how the onus is on those companies to beat. And right now, their net income is expected to grow 19% this year. So remember, this is the fourth quarter earnings season. So they're going to guide for the full year, 2024, and that's certainly going to impact markets. Now, the rest of the index is only expected to grow 9%. Okay. So it's really going to be on those big tech names to drive the market forward. Now, let's talk a bit about this new high, and I'll get to economic data in a minute. Right, here's the S&P. And we just finished Option X week, and this is one of the largest Option X periods of the year, January OpX. A lot of people write options, call options often in January, and there are basically reasons why the market money flows into the names that have the most option activity, and those big tech names do have the most. And so this could be a catalyst for, I don't want to say a peak, but I'll just say a peak, right? In the Qs, in the S&P, etc. You can see that with the momentum here. Look at the MACD is making a divergent low, or divergent. This is called the divergent high, excuse me, where you make a new high, but the MACD is not confirming. Same with the S&P. You have a high, but the MACD is not confirming. So be on the lookout for that potential reversal as we enter next week. That's why I say, should investors be worried? Okay. Now, let's dig into the economic data real quick before I get to the rest of the charts. Retail sales, that ticked up, shows the consumer is strong. Industrial production did tick up into positive territory after 2 months in a row of being in negative territory. Not a whole lot to glean from that. Import prices were flat, and that was, you're starting to see issues with global trade because of the Red Sea problem, and that's caused causing the cost of goods and trade around the world to increase. And so you're seeing that a bit on import prices. Export prices did stay relatively low, down about 0.9% month over month for the third straight month. Building permits ticked up, which is a harbinger for future building activity, but housing starts, which is what's happening now, that actually tick down. So the housing market remains mixed, even with mortgage rates pulling back. The jobs market, that was the most interesting part. Is you're seeing continuous claims actually tick down back about 1.8 million. And this is something I was saying that was an indicator for the Fed to pause, not about initial jobless claims, which is staying around the 200,000 per week level. It's really about who is losing their jobs and staying unemployed. And what you see here is that was ticking up through late summer into the into the fall. And as financial conditions have eased, and I can bring that up here, the jobs market has eased. So I'll show you this. This is the National Financial Conditions Index. And if this is going down, that means financial conditions are easing. I'll zoom out here so you can kind of see what this looks like. Here's the COVID crisis, right? So if it's going up, it means financial conditions are tightening. Throughout 22, obviously financial conditions tightened. And then into, we're kind of flat. You had a little bit of tightening into the fall, and then it's very much eased because of the dollar rise slowing down, as well as interest rates pulling back and credit spreads tightening. I'll show you that here. So there's SHYG, short-term junk to short-term treasuries. Remember, this is going up. That means credit spreads are tightening, and there's not any worry from the credit markets that there's going to be a major credit event. So this looks fine. The dollar index been increasing a little bit recently, but overall it's still in a general downtrend. Let's see what else. This is what I'll be watching. Growth to values. This is showing you how the growth. Look at this resurgence in growth, the growth side of the market. That is a big, big move. But why would that happen? There's not really any catalyst except for option X, as I talked about. So I'll be very interested to see if this can make a new high, recent new high. I zoom out to a weekly, and what you can see is this was the downtrend in 2022 as financial conditions got tighter and you had value outperforming. Remember, this is going down, value is outperforming. When it's going up, growth is outperforming. And what you see here is you can get weeks. This was the spring of 2022, and you had a little bit of a rally in growth versus value, and then it rolled right over. Same thing in the early summer, and it rolled right over. So you can get these big short-term moves. In fact, when you're in a downtrend, usually those counter moves are quick and short and can be fairly substantial, like you've seen. But you continue to make a series of lower highs and lower lows, right? And that's what you continue to see. So I'll be interested to see if you get your first higher low on the back of, as we go into, the next option X cycle, which would be the third week of February. But this is the time period next week where you should see this roll over. If it's going to the next week or two, let's call it. So I'll be interested to take a look at that. Let's look at oil prices. Oil prices, they kind of hung around here in the low 70s, and there's still, I think, a lot of battling going back and forth between increasing supply coming out of U.S. producers, and a lot of this has to do with better technology. That isn't changing the ultimate. When I say better technology, these drillers are able to pull more barrels out of the ground quicker from their shale projects. And that doesn't change the amount of total oil they're able to pull out. They're just doing it quicker. And so I think so what you're seeing is the decline rates are picking up, but near term they're actually producing more oil. So I think you're seeing depressed prices right now, but ultimately, unless they continue to do CapEx, which they're more reticent to do in today's environment, I think they're going to run into a decline in supply growth into next year. So that's something I'll be on the watch for. let's take a look. And so that's why I think this is a good buying opportunity in the oil patch. Let's look at gold. Gold did pull back on higher rates, but you had a nice Thursday and Friday. Still remains in a series of higher highs and higher lows. MACD is weakening a little bit, so I'll be on the lookout to see if this breaks down into below the zero line. Above the zero line is usually a uptrend, and this remains. So silver, that had a bigger setback, that remains relatively weak. So I would need that to get some traction. It's held this support level this week, but we'll see as we go into next week. And obviously, we have the Fed meeting, not this upcoming week, but the week after on the 30th and 31st was when the announcement will be. Now, we did get into earnings season this week and really last week, and the banks were the ones that had the, I'd say, biggest, I don't say fireworks, but were most followed. That was back here, and really there wasn't a whole lot of movement, just consolidation. This is the broker dealers, Morgan Stanley and Goldman Sachs mainly, and that's just been a modest pullback. So overall, those remain in a solid uptrend as the Treasury rates continue to stay subdued, and that's helping heal their balance sheets. And obviously, the consumer is holding together. So, yes, delinquencies are rising, but they're more of a reversion to the mean as opposed to something that's creating that broader credit crisis. And so, banks are healing to a degree. The 10-year here is into resistance on the 50-day moving average. We'll see if we can get some consolidation or pullback. I think we'll get some consolidation as we head into the Fed meeting the week after next. What else do I want to get to? The MOVE index. So this is the volatility of Treasury market, and this gives the Fed room, in my mind, to be a bit hawkish. And that was really the impetus for Davos, where a lot of Fed governors basically spoke hawkishly. And that moved, and I'll show you this. This is the expectation for the Fed rate moves. Still 98% chance of a pause this month. That hasn't changed much, right? That was 95% a week ago. So that's pretty much been priced in. But as we move out through the rest of the year, that's where things have changed. So the March meeting, we now have a better chance of a pause as opposed to a cut. Because a week ago, we had only a 19% chance of a pause in March and a 77% chance of a cut. Remember, the Fed was prognosticating 3 rate cuts by the end of the year. The market was pricing in 6. That was the median outcome when it comes to pricing in rate cuts. And what you see here is now it's more even. It's about, we'll call it 5.5, because where we are, we're at, let's call it 425, all the way down to 4 would be 5 rate cuts. All the way down to 3.75 would be 6. And if you go a week ago, there was a 40% chance we were all the way down here. Actually, it's 7. So we were close to 7 rate cuts was the highest probability. It's kind of bouncing back and forth between 6 and 7. Now we're bouncing back and forth between 5 and 6. So basically, an entire rate cut has been priced out of the market. And so I think this is coming more in line with the Fed dot plots. And we'll have new dot plots as we come out here with this next Fed meeting. And I think the market will slowly get closer to what the Fed is planning to do. Now this is important, but what I actually think is more important is what the Fed is going to talk about when it comes to QT. Because this isn't really going to impact much the ability for the Treasury to finance themselves. There's another $2 trillion of additional debt that we're going to have to issue this year. And the Treasury has been moving a lot of that issuance to the short end as opposed to the long end because they don't want rates to go back up. Now, the MOVE index as well as the 10-year pulling back, I think gives the Treasury and the Fed a little breathing room to be a little more hawkish on the Fed side, to push QT out a little farther, or the end of QT, let's say, a little farther, to continue to shrink their balance sheet, as well as the Treasury to issue more duration. And when the Treasury issued their plans for their debt issuance in July, that's when rates really started to go up because they're issuing a lot more duration, meaning bonds that mature 5, 7, 10 plus years. And remember, when banks or even individuals or investment companies, when they go buy duration, they're taking on risk. When you're buying short-term treasuries, right? I could use SHY. We use SGov as a good, very, very short-term bond ETF, treasury bond ETF. There's no risk here. Right? You can see this. This is just when they're paying a dividend, et cetera. So you're seeing there's no volatility in price. When you go buy short-term treasuries, that's not taking a risk. There's no credit risk and there's no duration risk. It's just yield. But when you go and buy a 10-year, I'll bring up IEF, right? You're taking risk because this can fall from 100 all the way to 89, right? You can go down 10% because you have duration risk. Same with TLT, right? If you zoom back out, this is huge risk. This fell from 170 all the way to 80. So you can see I think that will be a very interesting report is, and I believe that comes out next month, is what is their plan for issuance? And so I think that's really going to be the driver of the markets this year. Because we are now in a fiscally dominated economic environment. The government is spending because of entitlements and baby boomers retiring. And so that is going to create a lot of angst in markets. That money's going to have to come from somewhere. There have to be balance sheets that fit that. Now, there are a lot of balance sheets that will hold short-term treasuries yielding 5%. A lot of individuals are doing that, right, with buying into money market accounts, etc. But taking duration risk, that's another story. And so they're going to probably try to manage this. If you get more duration being issued, that means more private capital being pulled out of the market, liquidity being pulled out of the market. And you get a pullback like you saw in August, September, October. I think you can get a period like that. Not necessarily a credit crisis, but that capital has to come from somewhere, and it can certainly come from equities. And you also will get a rise in treasury bond rates, excuse me. And so it's really hard to say exactly where markets are going to go this year because a lot will depend on what the Fed and the Treasury do. Because they're so important to how capital is flowing. Is capital flowing into the market or is it flowing out of the market? And we'll continue to keep you abreast of that. Right now, they're still doing QT, but it's basically being sterilized by what is called a reverse repo facility. And if we can, but that's going to be exhausted sometime this year or this first half of this year. So that's why they're talking about getting rid of QT at some point, because once the reverse repo is fully drained, they may be forced to stop QT because of too much capital leaving the system. And so they're setting it up for them to stop it as opposed to doing it abruptly. Okay, so that's pretty much the long and short of it. I do expect a pullback and then, frankly, new highs in the first half of the year because of that liquidity situation remaining solid. But that doesn't mean you can't get a 5-10% pullback. Do you get a pullback into the 45 to 4,600 level on the S&P, maybe the 4,450, somewhere in that range? It's kind of what I'm expecting. Kind of refresh sentiment a little bit, get people a little bit worried, and then, you get new highs. But then you have the election in the back half of the year, and that's can mean a lot of things. So with that, I'll leave it there. I hope you all have a wonderful rest of the weekend. Appreciate you all tuning in, liking, and subscribing, and to this channel as well as our podcast, InvestTalk. I'll remind you that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a great weekend.